Intel stock approached a 25-year market cap high in April 2026. The question is whether the underlying business has actually caught up to that price. Welcome back. In this video, we're covering Intel's Foundry strategy, its process technology progress, the state of its core business segments, and what the valuation actually looks like from a risk-reward standpoint. As always, this is not financial advice. Do your own research before investing. So the intro question is whether Intel's business has actually caught up to that stock price, and the honest answer is more than it had any right to, given where things stood a couple of years ago. Intel is trying to do three things at once: fix its chip design, rebuild its manufacturing process, and convince outside companies to use its fabs. Q1 2026 is the first quarter where you can point to something outside of Intel's own internal reports, a concrete external win, and say the strategy is actually working. That's a different kind of evidence than management telling you yields are improving. To understand what's actually turning around, it helps to know how Intel's revenue is structured, because these aren't all the same kind of business. You've got four main segments. CCG is the consumer and business PC chip business, the one most people associate with Intel. DCAI covers data center, CPUs, and AI-related server work. Intel Foundry is the contract manufacturing arm, where Intel makes chips for other companies. And then there's Altera and NEX, which cover FPGAs and networking chips. Each of these is at a totally different point in its recovery. DCAI and CCG are generating real operating profit. Intel Foundry is still losing money, but the losses are narrowing. And Altera is just cyclically weak right now. It's not broken, it's waiting for its market to come back. The consolidated story only works if all four move roughly in sequence. Now, the single most important technical fact underpinning everything else in Q1 is that Intel's 18A manufacturing node is yielding ahead of its own internal targets. Yields in chip manufacturing just means the percentage of chips that come off the wafer actually working correctly. Higher yields mean lower cost per good chip, which flows directly into gross margin. Intel 18A combines two new technologies: RibbonFET, which is a new transistor architecture roughly comparable to what TSMC calls a gate-all-around device, and PowerVia, which routes power through the back of the chip instead of the front, freeing up the top surface for signal wiring. This is also the first 2-nanometer class node built entirely in North America. The fact that yields came in ahead of projections is what caused the gross margin beat, and it's the gating factor for essentially every other financial forecast Intel has made for the second half of 2026. One of the two technologies inside 18A deserves a closer look on its own: PowerVia. Backside power delivery means routing the chip's power lines underneath the silicon instead of sharing that space with signal wires on top. The practical effect is that you eliminate a major source of routing congestion, which lets you pack transistors more densely and run them more efficiently. TSMC has pushed its first deployment of a similar technology, they call it BSP-DN, to 2029. Intel is already on its second commercial generation with 18A and will be on its third by the time its 14A node ships. So the comparison isn't Intel versus TSMC at the same generation of this technology. It's Intel on Generation 3 before TSMC has shipped Generation 1. For context, the last time Intel held a process lead this wide was during its 22-nanometer FinFET era, roughly a decade ago. So to put the last two sections together, Intel has PowerVia running 3 generations ahead of TSMC, and it was first to deploy ASML's high NAEUV tool, the 0.55 NA model, before TSMC has shipped a single wafer on it. At the 1,4-nanometer node, that combination potentially allows single-pass patterning, which means fewer exposures per layer, lower cost, and tighter geometry control. These aren't software features you can copy in a quarter. They require years of capital spend and process learning to replicate. That's what makes them structurally durable leads rather than just temporary timing advantages. Now, process technology only matters for Intel Foundry if outside companies actually sign up to use it. And that's been the credibility gap for years. The Terafab partnership changes that framing. Tesla and SpaceX have committed to manufacturing on Intel's 14A node, which is the 1,4-nanometer class process we just covered. The target is somewhere between 100 and 200 billion chips annually. To put that in context, that's not a pilot program. That's anchor customer volume at the leading edge. Prior to this, Intel Foundry's external wins had been relatively small or limited to trailing edge work. Terafab is the first time a name-brand external customer has committed to Intel's most advanced process. Revenue from this won't show up until 2028, but the strategic signal it sends to other potential Foundry customers is significant. It answers the question of whether anyone credible would actually trust Intel to make their chips. Alongside the Foundry wafer business, Intel has been building out advanced packaging, and the scale of that opportunity has shifted pretty dramatically. Advanced packaging means connecting multiple chips together inside a single package using Intel's EMIB or Foveros technologies. The reason this matters for the Foundry story is that a fabless chip company might manufacture their silicon at TSMC, but still want Intel to handle the final assembly and interconnect work. That creates a revenue stream that doesn't require Intel to win the wafer contract. A year or two ago, Intel was describing this pipeline in the hundreds of millions of dollars range. Management is now characterizing it as a billions of dollars per year opportunity. The chart here illustrates that magnitude shift across 2 periods. It's a new revenue category opening up, not just existing customers spending more. The other major Foundry capital move in Q1 was Intel, buying out Apollo's minority stake in Fab 34 for around $11 billion. Fab 34, located in Ireland, is Intel's primary high-volume EUV facility in Europe, and until the buyout, Apollo held a significant ownership slice from an earlier financing deal. Buying them out eliminates the ongoing minority interest payments Intel was making, which were a recurring cost drag on the consolidated financials. It also means that when AI wafer demand peaks in 2027 and 2028, all of the economics from that fab flow entirely to Intel rather than being shared. The strategic logic is straightforward. The financial trade-off is worth noting, though. Intel funded part of this with new debt at a point when free cash flow is still negative. So it's a long-term accretive move that added near-term balance sheet pressure. Both things are true. So with all that Foundry context in place, the Terafab win, the Fab 34 buyout, the packaging pipeline, it's worth stepping back and asking where Intel Foundry actually stands right now as a business. The answer is still losing money, but on a trajectory that management says is improving every quarter through 2026. The path to break even runs through a few specific milestones. 18A scaling to volume production, the Penang packaging expansion coming online, and eventually the Terafab ramp beginning in 2028. None of those are guaranteed, but the directional story is at least internally consistent. For investors, the Intel Foundry operating loss line is the single metric that matters most for the rest of this year. Not gross margin, not EPS. If that loss is narrowing quarter over quarter, the thesis is tracking. If it stalls or widens, that's the first real warning sign. Shifting to the data center segment, DCA, I posted strong year-over-year revenue growth with meaningful operating margin recovery in Q1. Management described Xeon 6 as the fastest new product ramp Intel has had in 5 years, which is a claim worth sitting with given how much ground Intel lost in the data center between 2021 and 2024. Google Cloud's C4 and N4 instances are running on Xeon 6 and ASIC revenue. Intel co-designing custom chips with hyperscalers nearly doubled year over year. But the most strategically significant win of the quarter is one that often gets underreported. NVIDIA selected Xeon 6 as the host CPU for its DGX Rubin NVL8 server platform. That's NVIDIA's flagship AI server configuration. Intel isn't competing with NVIDIA here. It's sitting inside NVIDIA's most important product. That's a different kind of market position than winning a standard server RFP. The NVIDIA design win connects directly to something structural that's worth explaining carefully, because it's probably the most important long-term argument for DCAI. When you're training a large AI model, the ratio of CPUs to GPUs or accelerators in a server cluster is roughly 1 CPU for every 8 accelerators. You need the accelerators to do the heavy math, and the CPU is mostly managing traffic. But inference workloads, actually running a model to answer questions or complete tasks, are more CPU intensive. And as AI moves from pure training toward what's called agentic inference, where AI systems are making sequences of decisions and running workflows, that ratio is shifting toward something closer to 1-to-1. Intel doesn't need to beat NVIDIA in accelerators for this to matter. If hyperscalers are building inference clusters with 1 Xeon per accelerator instead of 1 per 8, Intel's CPU volumes in those deployments roughly octuple relative to the training era. That's the structural demand driver underneath the DCAI recovery. Turning to the PC side of the business, CCG, the story here is built around two things converging at the same time. First, Intel's Panther Lake chip, which is the Core Ultra Series 3 product built on that 18A node we've been discussing, delivers 50 TOPS of NPU performance. TOPS stands for trillions of operations per second. It's how you measure AI processing capability on a chip. Microsoft set a threshold of 40 TOPS as the requirement for what they call Copilot Plus certification, which unlocks a specific set of AI features in Windows. Panther Lake clears that bar comfortably. Second, Windows 10 reaches end of life, meaning Microsoft stops security updates. For enterprise IT departments, that's not a suggestion to upgrade, it's effectively a deadline. Commercial PC fleets have to refresh, and when they do, they're moving into the Core Ultra tier. AI PC revenue is already over half of client CPU mix. The upgrade cycle driving the surge is not optional for enterprise buyers. The PC market angle that often gets overlooked is what memory cost inflation does to the price tier structure. Right now, there's a meaningful chunk of PC sales in the sub-$500 range, budget laptops, entry-level desktops. But DRAM and NAND prices have been rising, and the projection is that by 2028, memory costs alone push most of those products above that price floor. That tier essentially disappears. The reason this matters for Intel specifically is that CCG's operating margins, which have been running around 40%, depend on the mix leaning toward Core Ultra rather than budget chips. If the low end of the market gets priced out, Intel doesn't need to take share from anyone. The market just moves up into the segment where Intel already competes. It's a structural tailwind that arrives whether or not Intel does anything differently. So after covering all of those individual business lines, it's worth stepping back and looking at what the financials actually say, because there's a meaningful gap between the non-GAAP story and the GAAP reality. On the non-GAAP side, the Q1 gross margin beat, that 650 basis point swing above guidance, was the sixth consecutive quarter where Intel came in ahead of its own internal targets. But on the GAAP side, Intel is still reporting a net loss. Restructuring charges are part of it. The accounting treatment around the Fab 34 buyout adds to it. Free cash flow is still negative, and gross capital expenditure remains heavy as the Fab build-out continues. The way to think about this is that investors right now are being asked to price a company based on where its financials are going, not where they currently are. The non-GAAP improvement is measurable and consistent. The GAAP profitability and positive free cash flow, those haven't arrived yet. Given that gap between the non-GAAP narrative and the GAAP reality, the question becomes, what do you actually watch going forward to know if the turnaround is tracking? There are three metrics that matter more than any others. First, the Intel Foundry operating loss trajectory. Management has guided for quarter-over-quarter improvement through the rest of 2026, and any deviation from that is the clearest early warning signal available. Second, non-GAAP gross margin sustainability. Q1 was a beat, but management guided for maintaining roughly that level in Q2, not expanding it. If Q2 comes in meaningfully below Q1, it raises questions about whether the beat was structural or one-time. Third, operating cash flow direction. Not positive yet, but the trend line matters. If you own the stock or are thinking about it, these are the three numbers to track each quarter. One signal worth noting alongside those metrics. Morgan Stanley revised its 2027 Intel EPS estimate sharply upward after Q1 and projects meaningful DCAI growth for 2026. When a sell-side model moves its 2027 estimate, not just the price target, it reflects a change in base case assumptions. That's a more durable shift than sentiment improving on a good quarter. It suggests institutional models are being rebuilt, not just adjusted at the margin. So about that 25-year market cap high mentioned at the start, what does that actually mean for someone thinking about buying or holding the stock today? When a stock approaches its highest valuation in a quarter century, the margin of safety compresses. You're no longer paying for a recovery that might happen. You're paying for one that largely has to happen across multiple programs at once. The Foundry ramp needs to execute. Diamond Rapids needs to ship on time. AI PC adoption needs to sustain its momentum. All three roughly in parallel. Any one of those slipping doesn't just hurt that segment, it undermines the valuation math for the whole company. That's the core tension at current prices. Now, the bull case has real evidence behind it. We've covered that. But it's worth laying out the risks that could break the thesis, because they're specific, not just generic macro concerns. Free cash flow is still negative, and GAAP losses persist, so the company is still burning through capital while building out the fab network. Diamond Rapids, the high-end Xeon successor, has slipped to mid-2027, which opens a window for AMD's EPYC lineup in the most profitable part of the server market. The Falcon Shores GPU pivoted to an outside manufacturer rather than Intel's own fabs. That's a retreat from the original vision. Terafab revenue doesn't show up until 2028, so there's a multi-year gap before Foundry economics normalize. And Altera's ongoing weakness is offsetting some of the strength elsewhere. One more caveat worth noting. Specific financial figures in the Q1 report were redacted, which makes independent verification harder than it should be. On the other side of that risk picture, there are specific events that could drive a meaningful re-rating, and they're not all equally likely or equally impactful. The most immediate one is Clearwater Forest, which is the first high-volume product shipping on that 18A node, expected in the first half of 2026. That's essentially a live yield test run at scale. If it goes smoothly, it de-risks the entire back half of the roadmap. Slightly further out, the Intel Foundry loss trajectory through the rest of the year either confirms or denies the turnaround. And on the 14A side, any public disclosure of additional Foundry customers beyond Tesla and SpaceX would be the single highest impact re-rating event available, because it would show that Terafab wasn't a one-off relationship, but the start of a real external customer base. Pulling everything together, the inflection evidence in Q1 is credible. The 18A yield story, the DCAI recovery, Terafab. These aren't projections anymore. They're observable outcomes. But with the stock trading near levels it hasn't seen in 25 years, the investment question has shifted. It's no longer whether the turnaround is happening. It's how much of it is already reflected in the price you'd pay today. For investors who got in earlier, that's a different calculus than for someone evaluating a new position right now. The upside requires concurrent execution across Foundry ramp, server product cadence, and AI PC adoption all over a multi-year window. That's not impossible, but it means the risk is asymmetric in a way it wasn't 12 months ago. So where does that leave things? The IDM2 thesis, the idea that Intel can simultaneously compete in chip design, own its manufacturing process, and run a credible external foundry, is no longer just a plan. Q1 2026 gave it hard external evidence for the first time. Yields ahead of projections, DCAI recovering, and a real anchor customer in the foundry business. That's a meaningful shift from where things stood a year ago. But free cash flow is still negative, GAAP losses persist, and Diamond Rapids has slipped. The turnaround is underway. It's just not finished. And with the stock near levels it hasn't seen in a quarter century, the price already reflects a lot of that progress. If you're watching this and evaluating Intel as an investment right now, the thesis is intact. The execution risk, though, is higher than it was before the re-rating. Keep an eye on Q2 gross margin sustainability, the Intel Foundry loss trajectory, and any additional 14A customer disclosures. Those are the three things that will tell you whether the story is still tracking. That's the full picture on Intel. The progress, the risks, and the valuation tension heading into what could be a defining stretch for the company. If you have questions or a different view on any of this, drop it in the comments. I'd like to hear where you land. Thanks for watching, and I'll see you in the next one.